I do welcome you to today's conversation in entrepreneurship. And what I want us to look at today now is business financing, right? Um, it should be last time when we learned budgeting. You were there in the previous time, last time's class, right? Were we there in the last time's class?
I was there.
Okay, yeah. So we talked about what we talked about, but as for now, let's look at business financing. So as entrepreneurs, we have indicated that it is very important to develop those ideas, refine the ideas, and at the end of it all, you should be able to develop the products and the services um, that you should be able to sell to the market. Now, it is very, very important, and we cannot just conclude the course without talking about this aspect. The aspect of business financing. Where do we get the finance to finance those projects, to finance those areas of concern? Right? When we have those projects around, when you have those ideas, where do we get the money to power those ideas? It's very crucial and very important that we learn we learn the sources of finance. You know, financing is very, very important for every business. Every business needs financing. Okay. So as we are financing the business, you'll understand that there are different sources of finance that we can just decide. Okay. And most of these are grouped into the internal and the external sources of finance, right? The internal sources of finance are those that come from within the business, or there are those that we can raise from within the business or from within our reach. Then the external sources of finance are those that come from outside the business. Where do we get the money to fund and finance the projects and ventures that we undertake as the business? So looking at the internal sources of finance, let's look at the first one. So number one, to start with, in oftentimes as startups, people can use the personal savings, right? The personal savings or the reserves to start the business or start this business venture. So what usually happens is that there are some people that understand, and of course, people need to understand. They have this plan that at some point they're going to start this venture. And so they know that it's important that they raise finance for that particular venture to be powered. And so what they do, they make some savings. So you can still use the personal savings to finance the project. That is very important too, right? Then still people can still borrow money from the friends and from relatives. Okay, there are those people that might have good friends around. They might have good relatives that may be there to finance those small ventures, and people can start up those ventures. Sometimes people can decide to partner with others, and as you try to partner with others, this can actually help you to raise income, to raise capital. Okay, because when you partner with others, at least each one of you is going to put something, and then through partnering, you find that it may be easier for you, of course, to raise finance. That is important too. Okay. The other internal source of finance would be, equity, right? Share equity. Let me just mention about share equity. Now, with share equity, what we mean is that a company issues part of itself so that it can raise capital, right? So there is that time when you formulate this company and you realize that you need income, right? So as you need income or you don't have enough money, you you want others to bring money. So you decide to issue part of the company, part of ownership of the company. and so that those people that have money, they can come and buy, right? Buying the part of the company. Now, if people come to buy the part of the company, we say that they have come to buy the shares, or they have bought the shares, right? So when a company goes on the stock exchange to ask the public, so that those people that are interested in that company can invest, can buy shares, part ownership of that company, then what the money that we get from the issuing of shares is equity as well. So it's one of the sources of finance for the businesses to issue part of the company and sell it to the people, so that the people can bring finance. Then the other one that we can use is what is also known as the retained earnings. Now, what we mean by retained earnings for the business, we mean that the business can make profits. After the business has made the profit, of course, there is that fraction of the profit that you don't want to give to the shareholders, to the owners of the business, and you just want to keep it, okay, so that you can keep it in the business. So that fraction, or that money that you keep in the business, that you are not going to give out or issue as dividends to the shareholders, is what is known as the retained earnings. And it's usually one of the sources of finance. So people use the retained earnings and they use the general reserves to finance their capital. These are the internal sources of finance. They use the general reserves, they issue shares, okay, so that they can raise what is known as share capital, right? Share capital or equity, right? They raise share capital, ordinary shares, of course, and they can also get finance from the general reserves. Okay, so these are some of the sources of finance, internal sources of finance, yeah, that the business has, and this is where people can get the finance. Okay, then we also have got these this other source of finance. These, we call them the angel. These actually are private investors who are wealthy individuals, often entrepreneurs, who invest in the startup businesses in exchange for equity. Usually these are people, they have the money. There are some people, they have the money, but they don't just have the idea, maybe to start up the business or something. They have the money, but they have not known what to do with the money. It's possible. So at that time, those people, they are looking for startup businesses whose proposals and the plans are viable, so that they can invest their money in those businesses. Usually that is what happens. So even those people, the investors, they are a source of finance, and the companies or the startup companies can still go and they ask for finance from these people. Of course, we ask strategically. You don't just say, I'm asking for money, but instead what you do, people write business proposals and then they present these business proposals. And as they present the business proposals, you find that people will come to bring the money. Okay. Now, the part of like the capital structure of of the company, usually it is made up of two main components. There is the part for equity, and the other part that is made up of debt, right? We call this debt capital, right? Now with equity capital, this is a part of capital that has been raised from the owners of the firm, from the shareholders, okay? That's equity capital. But the debt, this is the one, the part of capital that has been raised from others, right? From the people that are not the shareholder, that are not the owners of the company. Now, about the debt capital structure, we can look at some external sources of finance. This money comes from outside the business. We can start with the commercial banks. We can start with commercial banks as well. They are also a source of finance. So the commercial banks, usually they help a lot of the startup businesses, and they do provide short-term debt to the entrepreneurs. Okay, so people can take advantage and go to the commercial banks and borrow capital, borrow money from the central, from not the central bank, sorry, the commercial banks. And so you can get for a short term, the short term loans are usually for a period, they are repayable in a period that is less than a year or maybe equal to a year. Then the medium term ones, usually it's above 1 year, but less than 5 years. And for a long term, it's usually more than 5 years. So you can borrow, okay? You can borrow from the bank. Now, to secure a bank loan as an entrepreneur, typically you will have to answer a number of questions. Together, these, questions, if you answer them, they will help you before you go to the bank on some key things that you have to work on. Number one, what do you plan to do with the money? So in the business proposal or in the plan, that should be clear. What are you going to do with the money? When do you actually need the money? When exactly do you need the money? How long do you need that money? And how are you going to repay the money? When you answer these questions, they help you, okay? They help you because if you are able to answer these questions properly, the banks at least they will see that this person at least has a plan on how they are going to pay. They have a plan on how long they are going to hold on to the money. They even know how much they need, and they know what they are going to do with the money, okay? So usually that is what happens. Now, you see, the bank does make decisions, right? Those are called the lending decisions. So they have to look at there are some of the conditions that are there that the bank looks before they can actually guarantee you or give you the loan. And these are called the 5 C's. Let's look at the 5 C's that the bank looks at. Number one, the capital. So a small business must have a stable capital base before a bank will grant a loan. Because, if you don't have a stable capital base, the bank cannot, usually banks are hesitant to give such small businesses. So at least the capital base should be very stable. Yeah, it should be stable. Then they also look at your capacity. So the bank must be convinced of the firm's ability to meet its regular financial obligation and repay the loan. They have to look at, are you really able to pay back? Very important. The banks also look at the collateral, okay? These would include things like assets that the owner, of course, pledges to have. So those assets are very important too. So they look at the value of the asset. And then oftentimes you find that the value of an asset is expected to be higher than the amount that the person wants to get, right? It should be higher or twice the value of the money that you want to get, right? So they also look at the character, okay? So on the character part of it, remember these, most of the times when you're looking at, how should I say it? We can put it under character. We can even replace it by putting reputation or goodwill. So that if the person, if this business is not a sole proprietorship, it's not just one person, it's maybe a partnership, the bank will also have to look at the reputation that that company has. Does it have good name? But if it's about the owner is just one, like it's a sole proprietorship, they will focus on the character of the sole trader or the sole proprietor. Then the last C that they look at is the conditions. The conditions that surround a loan request. They affect the owner's chance of receiving yeah, the funds too. You see, the important conditions that influence the banker's decision is the shape of the overall economy. That would include the interest rate levels, the inflation rate, the demand for the money, among others. And you find that those actually they do determine, or they do help the bank before they can grant somebody a loan. Do I have any question? Okay. Right. So we can look at the microfinances. The microfinances, these are financial institutions that give they give the financial services most of the times to small business enterprises. They do give the finance. Then we have the trade credit. Now, with the trade credit, this is a credit that is given by suppliers who sell goods on account. So what happens is that there is that time when you don't have money, then there are some suppliers that you can go to and you ask them to give you to supply you with the goods with an agreement that you're going to pay with, of course, within the designed period of time. So what happens is that those suppliers are going to supply to you on credit. They're going to supply to you on credit. So that is also a source of finance because they will allow you to sell those goods. You can have an opportunity to sell those goods and then supply them within the time limit set by them, right? We also have got those people that supply equipments, right? Because most of the small businesses or the startup businesses, they need equipment. Actually, all businesses need equipment. So there are those suppliers that can supply equipments. And as they supply these equipments, they can even supply these equipments and help you to pay, okay, at usually later, a bit later. Of course, we have got those facilities where people can get an asset, start using an asset, and then they be paying slowly until they finish. Even the debtors are also a source of finance. By debtors, we mean the accounts receivable. By accounts receivable, we mean those people that bought things from you as a business, of course, on credit. There are those people that got goods from you on credit or services from you on credit. So if you know how to manage debt properly, you may find that those people will be able to pay back. So if they pay back, that is really a good thing. And you may have, of course, a source of finance from them. The credit unions, they do give, and including the bonds serve as a source of finance, right? So there is that time when a company can issue the bond, right? Which is just a long-term contract in which the issuer of the bond, who is actually the borrower of the money, will agree to make the principal and the interest payment on a specific date to the holder of the bond. The bonds always, have just been there for a long time. So what happens when it comes to the bonds? The person who wants the money, of course, in this case, the company that needs the money, they'll issue a bond. Okay, issue a bond. Now, those bonds that are issued by companies are called the corporate bonds. Okay, we call them the corporate bonds. But those that are issued by the government, they are called the government bonds. Usually, they are issued by the central bank. Okay, the central bank issues the bonds. A bond is just more like, it's a request, like the bond issuer is borrowing money, like they don't have enough money, they want money from the people, right? As they want money from the people, they can't just go and say, I'm asking for money. So there should be some signing somewhere. So how it works is that they will get some money. Let's start from the corporate bond. for a company. When they issue a bond, they will sell some bonds and say, we are selling these bonds maybe at a face value of 1,000. Okay, you buy, you bring a 1,000 to buy one bond 1,000. In this case, let's use the Zambian kwachas and say kwacha. So you buy a 1,000 kwacha, and as you use the kwacha, whatever the currency it is, you take that amount to the company. The company will hold on to that money. Then they are going to give you a piece of writing, a certificate, that agrees, that shows that you have agreed. They agree, they certify that indeed we owe this person the money we have. This person has borrowed us the money, this amount. We are going to pay this person on such a date, and the amount that we are going to pay is this money, and the interest rate that we are going to put is this much. Okay, so you make that agreement. So you leave the money, and then you have that agreement, and then they are going to be paying that interest, and at the end of it all, they also pay the principal amount. That is how a bond works. So you can issue a bond when you do not have enough money, and the people who have money, they will come, they'll bring the money, and then they'll hold the bonds. Okay, they will hold those bonds, and when the bonds mature, they'll come to get their money. Of course, you have to send their money, and that is how it works. So it's another source of finance. Hello, do I have any questions so far on the sources of finance? Hello, am I audible enough?
Yes, sir.
Okay. All right. So basically, those are some of the sources of finance that we have. But we also have got what we call finance lease, a lease, right? Leasing. Okay. Now with leasing, what happens is that it's an agreement where you agree to use a fixed asset. Okay, you agree with the owner of the asset that you're going to use their fixed asset for some time. And again, during that period that you're going to use the asset, you're going to be paying some rental payments. Okay, there is some money that you're going to be paying as the rental payment. So that amount of money that you're going to be paying as the rental payment, right? Sorry. So I was just from saying that there is that amount of money that you are going to pay. You'll be paying small like rental belong to you. Okay. It doesn't belong to you. It is not yours. It's going to be in the period that you agreed, you're going to take back to the owner, or the asset will go back to the owner. It's also one of the sources of capital. Because there are those times when, especially when it comes to some assets, the fixed assets, you may not have enough money to buy those fixed assets. And so literally what happens is that in this arrangement, and then you're going to be paying for an agreed period of time. Then afterwards, honor the asset okay, usually is due for beyond for Right. So I was just saying all those are the different sources of finance. Do I have any questions so far? Hello, is there any question?